In the vast, fast-paced world of financial markets, have you ever paused to consider how we truly ensure fairness? How do we prevent those hidden schemes that can quietly erode trust and, well, leave investors vulnerable?
It's a really fundamental question, isn't it?
Yeah,
Especially when you think about the sheer volume, the speed of transactions, all that information flying around every single second.
absolutely. And that's exactly what we're going to try and unravel today. This deep dive is all about prohibited and illegal trading activities in securities.
Right.
Our mission really is to cut through the, let's face it, pretty dense financial industry materials and regulatory guidelines. We want to give you a clear shortcut to understanding the essential guardrails, the rules of the road for the securities market. We're here to pull out the most important nuggets of knowledge, helping you see how financial markets are genuinely kept, well, honest and transparent. I'm actually really looking forward to uncovering some of the maybe surprising facts behind how these regulations protect investors.
And looking at the bigger picture, this isn't just about ticking off a list of do's and don'ts. Right?
No, exactly.
It's about understanding the why behind these rules. They're the absolute backbone of maintaining market integrity, making sure investors can participate with, genuine confidence.
Okay, let's unpack this then. When we talk about market manipulation, which is a huge topic, where do the regulators even begin to draw the line?
Well, the bedrock, the real foundation of anti-manipulation rules, is found in the Securities Exchange Act of 1934,
hmm
particularly what's known as Rule 10b-5.
Okay, Rule 10b-5.
Yeah, and its real genius, I think, lies in its sheer breadth. It doesn't just list, Act A, Act B are illegal.
Yeah.
It's designed very broadly to catch any scheme or device to defraud.
Any scheme?
Right,
What?
or any false statement, or leaving out a material fact, an omission, or basically any act that operates as fraud or deceit when you're buying or selling securities.
So it's deliberately broad to catch new tricks.
Exactly. That adaptability means it can address new forms of manipulation that, frankly, regulators might not have even conceived of back when the rule was first written.
So it's an incredibly broad net designed to be flexible. But were there specific areas or types of companies, maybe, where its reach needed to be explicitly nailed down, or places people might try to find a loophole?
That's a really key point. To make absolutely sure no security or no individual slips through the cracks, regulators also specifically extended these prohibitions.
Ah, okay.
So SEC Rule 10b-1, for instance, applies this anti-fraud idea even to securities that are normally exempt from SEC registration.
Got it. Even the exempt ones.
Yep. And then SEC Rule 10b-3 specifically extends the prohibition to broker-dealers. So you put them together, and these provisions essentially prohibit the manipulation of any security by any person or broker-dealer. It's designed to be, well, a pretty comprehensive legal shield.
That sounds like a truly foundational rule. Let's dig into some specific forms of market manipulation now, starting with misrepresentations. What might seem like a simple statement, but is actually manipulative.
Yeah, it's interesting how even seemingly harmless statements can cross the line. Under SEC Rule 15c13, it's actually considered a manipulative act for a brokerage firm to suggest that just because it's registered with the SEC, that somehow implies the SEC approves of the firm.
Ah, using the registration as a sort of badge of honor it doesn't actually represent.
Precisely. The SEC simply requires registration. It doesn't endorse the firm. It doesn't endorse its activities. The insight here is it's about preventing a false sense of security for investors, stopping firms from leveraging a basic procedural requirement into something that sounds like an endorsement.
Right, that makes sense. Now, we've talked about broad manipulation, but let's maybe go back in time a bit. Can you imagine a scenario where the very firms bringing new stocks to market were secretly rigging their prices? I mean, it sounds like something out of a movie, but apparently it was once a stark reality.
Oh, unfortunately it was. Historically, before the 1930s and the big regulations came in, the syndicate members underwriting new issues, the ones bringing the stock public, would often manipulate the market for those very shares.
So they'd pump up the price while they were selling?
Essentially, yes. And then, once these underwriters sold their allocation and, crucially, stopped their behind-the-scenes activities, the stock price would frequently just plummet, which, of course, caused significant losses for unsuspecting investors who'd bought in.
Right, so that's where Regulation M comes in.
Exactly. To prevent this, the SEC established Regulation M. This rule, and it applies to both initial public offerings, IPOs, and also additional public offerings, it strictly regulates trading practices around new issues.
Okay, so when Regulation M came into play, what was its fundamental approach? How did it stop firms from rigging these new issues?
Well, the core restriction is that distribution participants, so underwriters, the issuers themselves, others involved in the offering, they are significantly restricted from aggressively bidding for or purchasing the stocks that are currently being offered, but in the secondary market.
So they can't interfere with the regular trading price while the offering is happening.
Not aggressively, no. They are allowed to create what are called passive markets, meaning they can participate, but not in a way that actively drives up the price. But a particularly egregious prohibited practice under Regulation M is something called tie-in arrangements, sometimes known as laddering.
Laddering, that term kind of evokes someone trying to climb to a higher price, doesn't it?
Precisely. That's the idea.
Yeah.
It's illegal to allocate IPO shares based on securing prearranged purchase orders from customers in the aftermarket.
Huh.
So after it starts trading at a specific predetermined higher price.
So I'll give you IPO shares if you promise to buy more tomorrow at X price.
Exactly. The whole purpose is to artificially inflate the IPO's aftermarket price and, encourage other buyers to chase it, thinking there's huge demand. It's also illegal to urge clients, before the IPO even starts trading, to tell you information about what price and how many shares they're willing to buy in the aftermarket.
Got it. Are there any exceptions, like what if the price is genuinely falling hard?
Yeah, there are specific exceptions, like stabilization. That's where the underwriter can support the price, but only at or below the public offering price, the POP. It's meant to prevent significant declines, but it has to be done under very strict conditions. It's not a free pass to manipulate.
Okay. Shifting gears a bit to how prices are influenced by information. I mean, the internet and social media have undeniably amplified the potential for spreading false or misleading stuff to sway stock and bond prices. It's often hard to tell what's real
Oh,
anymore.
absolutely. And this is where we talk about market rumors. And, the most notorious example is probably the pump and dump scheme.
The classic pump and dump.
Right. It's a classic manipulation tactic.
Right.
Large investors or groups who own a stock will circulate false positive news about the company. Maybe fake press releases, social media buzz to incite a buying frenzy. That's the pump.
Get everyone excited.
Get everyone excited, drive the price up. Then, before the news can be verified or the hype dies down, they quickly sell their shares for a profit. That's the dump. And the stock often crashes afterwards. What's really insightful, or maybe scary here, is how easily instant communication platforms can be weaponized for these kinds of schemes.
Right. So moving on from rumors, the idea is that you also can't profit from a sneak peek at future market direction, correct? Like if a big trade is coming, you can't jump ahead of it and profit from that knowledge before everyone else knows.
That's the core principle behind prohibiting front-running. It occurs when a broker-dealer, or really any person, executes an order for their own account, a proprietary account, or an account they control, a discretionary account, while they're aware of a large, impending, unexecuted block trade.
And a block trade is just a really big order.
Yeah, typically defined as 10,000 shares or more, or options representing that number of shares. The market understands these large orders can influence the price, right? So taking advantage of that advanced knowledge gives an unfair edge.
Makes sense.
And this prohibition applies until that block trade information becomes public knowledge, usually via reporting on the tape or a third-party newswire. And importantly, it also covers related securities, like if the block trade is in common stock, you can't front-run using convertible preferred stock or bonds or options on that same company. It's all about maintaining a level informational playing field.
Yeah, this really highlights that inherent tension, doesn't it, between a firm's own research insights and its trading activities. It seems like a constant tightrope walk to manage that potential conflict.
It is, and it's precisely why the Financial Industry Regulatory Authority, FINRA, has a specific rule prohibiting a firm's trading department from, say, establishing, increasing, decreasing, or liquidating an inventory position in a security based on material, non-public, advanced knowledge of an upcoming research report for its own research department.
So the traders can't trade based on what the analysts are out to publish?
Exactly. This is often called trading ahead of research. And the crucial safeguard here, the really key mechanism, is the requirement for firms to establish and enforce strict information barriers. You often hear them called Chinese walls.
Right, the Chinese walls.
Yeah, these are robust internal policies and procedures designed to separate departments like research and trading, physically and electronically, preventing insider trading violations by restricting the flow of that sensitive, non-public information.
Okay. Now, let's look at some direct protections for the investor's account itself. One activity that sounds like a serious betrayal of trust is excessive trading.
Right, that's known as churning. It's defined as excessive trading in customer accounts, primarily undertaken not for the customer's benefit, but to generate additional fees and commissions for the broker or the firm.
So just trading back and forth to rack up charges.
Pretty much. And what's important to understand is that there's no magic number of trades. No specific percentage of portfolio turnover that automatically defines it as churning.
Ah, it's more about the context.
Exactly. Instead, the trading activity is assessed in light of the customer's stated objectives, their financial situation, their risk tolerance. Is this level and frequency of trading suitable for this particular client? And crucially, a client doesn't even need to lose money for a churning violation to occur. The focus is really on the intent behind the trading and the excessiveness relative to the client's actual goals.
So it sounds like maybe some clients might try to game the system in a different way by not actually putting up their own cash for trades. What's the common term for that, and how do regulators crack down on it?
Yeah, that's called free riding. This is a prohibited practice where a customer buys securities, maybe the securities appreciate in value pretty quickly, and then the customer sells or liquidates a portion of those same securities to cover the initial payment requirement.
Without ever actually depositing their own funds to pay for the original purchase.
Exactly. They're trying to use the market's money, essentially. Regulation T is very clear on this. Payment for securities is due promptly, typically by 2 business days after the settlement date.
Okay. And what happens if they don't pay?
If payment isn't made on time, the broker-dealer must sell out the securities and, importantly, freeze the account for 90 days. During that 90-day freeze, the customer has to have sufficient cash in the account before any new purchases can be made.
Ouch. 90 days of pay in advance.
Yep. The insight here is it prevents someone from trying to profit from a trade without ever genuinely putting up any capital, which, undermines the whole integrity of the settlement process.
Right. Shifting gears slightly again to maintaining overall market integrity, what about those actions that subtly manipulate prices, maybe just at key moments, like right at the beginning or the very end of the trading day?
Yes. Those are practices like marking the close or marking the opening. This basically describes a series of transactions, often near the market close or sometimes near the open, that are designed to artificially uptick or downtick a security's price, make it close higher or lower than it naturally would have.
And why would someone do that? What's the motivation?
Well, there are a couple of primary motivations, usually. First, brokerage firms use a security's closing price to determine customer margin requirements. So if a stock drops below a certain threshold, say $5, it might trigger a 100% equity requirement in a margin account. Manipulating the close might avoid that.
Ah, to avoid margin calls. Okay.
Right. And second, the closing price is often the final price displayed in newspapers or online financial summaries. So manipulating it can influence investor perception, make a stock look stronger or weaker than it is.
Affecting the headlines, basically.
Yeah. And this can also have a knock-on effect, potentially affecting the value of market indexes if the manipulated stock is a component of that index. Think of a trader who maybe consistently places buy orders right at the end of the day to uptick their firm's quote, making it the highest bid nationally, only to maybe downtick it again the next morning. That pattern is a huge red flag.
Definitely. Okay, what about market makers? When a market maker puts out a quote, there's a basic expectation of what that means, right? They have to stand by it.
Absolutely. Market makers are broker-dealers that regularly trade securities for their own proprietary accounts, and they display bids and offers. They must honor their displayed firm quotes. That means both the price and the stated size when they're contacted by another dealer or a customer wanting to trade.
And if they don't?
If a market maker fails to honor that quote, maybe they refuse the trade or change the price after being contacted, it's considered a backing away violation. This is a serious breach of FINRA and SEC rules. It can lead to disciplinary action, fines, suspensions. It directly undermines the transparency and reliability of the quoting system everyone relies on. And then sort of related to fair dealing between market participants, we have the anti-intimidation coordination interpretation.
Okay, what does that cover?
It basically prohibits a range of bad behaviors, things like coordinating prices or quotes with other firms, directing or even just requesting another member to change their price, or really engaging in any conduct that threatens, harasses, coerces, intimidates, or tries to retaliate against the legitimate competitive activities of other market participants.
So basically, don't try to bully or collude with other players to fix prices or stifle competition.
That's the gist of it. And it applies whether the quotes are on an automated system or handled manually. It's fundamentally about the behavior itself, ensuring fair play.
Okay, so Beyond direct trading or quoting shenanigans, how else might someone try to improperly influence prices? Maybe through media or other
Yeah,
outlets.
that's covered too. Broker-dealers are explicitly prohibited from paying any party, and this especially includes electronic or public media outlets to influence a securities market price.
So you can't pay a journalist or a website to publish something positive to boost a stock you hold.
Exactly. Now, firms are absolutely allowed to pay for legitimate advertising, and they can issue their own research reports based on genuine analysis. That's fine. But compensating someone specifically for direct price influence, that's completely off limits. The core idea here is that information impacting a security's value must be genuinely objective, not, bought and paid for propaganda.
Right. Got it. Now, let's talk about some essential protections specifically for customers, starting with best execution. This sounds like it should be a given, but what does it really entail in practice?
Yeah, best execution. It's a really fundamental duty for broker-dealers. Under both FINRA and the Municipal Securities Rulemaking Board, the MSRB rules, firms must use reasonable diligence to assist their customers in getting the best possible prices on both purchases and sales, given the circumstances.
Reasonable diligence. What does that actually mean? How is it measured?
Well, it's not just about the price alone. To determine if a firm has exercised reasonable diligence, regulators look at several factors. Things like the general character of the market for that specific security, its price, volatility, liquidity, the size and type of the transaction, the number of markets the firm actually checked for quotes, how easy it was to access those quotations, and of course the specific terms and conditions of the customer's order itself.
So it's a holistic view.
It is, and it's worth noting, particularly for municipal securities, the market is much less centralized and often less liquid than the stock market. So the best execution standards there are sometimes viewed a bit more broadly to account for those unique market characteristics. It might take more effort to find the best price.
That makes sense. And for municipal securities especially, you often hear they have unique characteristics that might require more specific information for investors beyond just, say, the price and yield.
Precisely. And that's why we have MSRB Rule G47, which covers time of trade disclosures specifically for munis. Municipal securities dealers have an obligation to disclose all material information about the security that is either known by the dealer or is reasonably accessible to the market, and they have to do this to the client at or prior to the time the trade is actually executed.
And this can be verbal.
It can be verbal or in writing, and material information is key here. It's defined as information that a reasonable investor would likely regard as important or significant when making an investment decision about that muni bond.
So it's more than just pointing them to a website.
Oh, definitely. It's not enough to simply direct a customer to some general industry source or point to advertising materials. The disclosure needs to be specific to that trade, that security, and provided directly. And importantly, this rule applies to all transactions, whether the trade was recommended by the dealer or was unsolicited by the customer. The insight here is really the heightened standard for disclosure required in that less transparent municipal market.
Okay, one more practice to cover, interposition. This one sounds a bit like inserting an unnecessary middleman, right? Is that the idea?
That's basically it. Interposition refers to inserting a third-party firm between a customer and the best available market price. And it's generally prohibited when it harms the customer.
When it harms them, how would that happen?
Well, the classic example is adding an extra layer of markups or commissions. Let's say a broker-dealer gets an order from a customer to buy shares. The best offer available directly from a market maker is $40. But instead of going straight there, the broker-dealer routes the order through another firm, the interposed firm, which buys at $40 and then sells it to the original member firm at, say, $41. That firm then sells it to the customer at $42.
Ah, so the customer pays $42 when they could have gotten $40, and two firms split that extra profit.
Exactly. That extra $2 markup ultimately harms the customer because an unnecessary intermediary was inserted.
So it's only prohibited if it harms the customer. Are there any situations where using an extra middleman like that isn't a problem or is even okay?
Yes, that's a crucial nuance. Interposition is not prohibited if the member firm can genuinely demonstrate that using that third party was actually beneficial to the customer.
Beneficial.
Well, maybe using a specialized broker's broker allowed the firm to access a demonstrably better price or find liquidity that wasn't otherwise available. Or perhaps the order could be efficiently crossed with another retail order from a different client handled by that intermediary. In some rare cases, maybe disclosing the firm's identity directly in the market could have adversely affected the price execution to the customer's detriment, and the intermediary provided anonymity.
Okay, so there have to be concrete benefits.
Concrete demonstrable benefits to the customer, and it's very clear in the rules. A firm simply saying they lacked sufficient personnel or didn't have the right technology to go directly to the best market is not a valid reason for interposition that results in a worse price. The burden of proof is always squarely on the firm to show the customer came out ahead because of that extra step.
Well, we've certainly covered a wide range of illegal and prohibited activities today. Everything from the really broad strokes of market manipulation and the misuse of information, right down to specific rules designed to protect individual investor accounts and ensure fair dealing.
And ultimately, understanding these rules really does empower you as an investor. It helps you better navigate the financial landscape, maybe spot potential red flags, and just generally identify practices that could undermine market fairness.
Yeah, it gives you the lens, doesn't it? Having the knowledge to recognize when something isn't quite right and understanding why those guardrails are actually in place to protect everyone.
Mm-hmm.
And maybe for you, our listener, this raises an important forward-looking question. How do you think the constant, relentless evolution of financial technology, think AI, high-frequency trading, crypto, and the ever-present influence of social media, how will these things continue to challenge regulators in their ongoing effort to maintain fair and transparent markets? Something to ponder as you look at your next investment decision.